Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or any independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing in the webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services meant to teach the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying a guarantee any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harms from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Ta-da! Now we can start. All right. Oh, and already there's a question. Look at that. Outlook. Oh, poor Outlook. What, do you agree with this late cycle talk on auto in general? How do you see Ford performing? No, I don't agree with late cycle talk. I think people are idiots. Okay, here. This is very, very important. Extrapolation. This is one of my favorite cartoons of all time. If I can find it. Oh, here you go. Error. Thanks. Anyway, this is anyway. It's not that big, I guess, on your screens. But anyway, so this is the problem with 99% of all the analysts out there is that they do this. Okay. Everybody is so excited to call a trend and bring attention to themselves on how clever they are to be the first one to see something that they jump all over it, okay? So in this case, you know, the exaggerated example here is that yesterday she had no husbands, today she has one husband, therefore at this rate, by the end of the month she'll have 30 husbands. Because obviously, since you went from 0 to 1 today, you'll keep going. Now that's interesting because we were just talking about Tesla's... If you want another example of it, look at Tesla's prediction for how many cars they're going to make compared to reality. Here you go. Here's Tesla in 2013 telling, or actually it's probably in 2012, saying they're going to make this many cars by 2020, right? So we're now in 2016 when they're supposed to be making 100,000 cars. And they're going to make the Model S, the Model X, the Model 3, blah, 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 right? So here's what actually happened. So in 2013, they made 10,000, and that's another, give them 14, say there. So let's say 24,000 oh, no, I'm sorry, that's not 13. I apologize. It's 15 and 22. So they made 22 and 13. They were right on schedule, and maybe that's when they made this prediction. I don't know. Then in 14, though, things already start going a little bit wrong. And in 14, it's 10, 18, 25, 32. So here's 32. Oh, no, it's 32 and 14. That was actually on schedule. So here you go. They think they're going fine, but then all of a sudden in 2015, it's supposed to be 55,000, and it's not. It comes in more like 33, 40, 50, just barely 50,000. Not too terrible. But now we're into 2016, and things have gone awry. And they are nowhere. They're so far from 28,000. They have 28,000 in the first half of the year. There's no possible way on earth they're going to hit their target. Not even, 28,000, they're barely going to hit this target, 50,000. Not only that, though, but the mix is wrong because they're not selling Model X's. They're not selling 50,000 Model X's. That's crazy. So, you know, that's the thing. So when you get back to extrapolation, Everybody looks at something that happens and they start making these projections. And they say, oh, if it went that way, it's bound to go this way. Nobody thinks that if something goes this way, it's going to go that way, and then whatever. But this is what reality is like. Okay? If I bet here that this stock is going to go down, I don't even know what stock it is, it doesn't matter. I mean, if I bet here this stock is going to go down, then it is going down, but it takes a long time. All right? I mean, it starts out going down, good, and everyone goes, oh, great trade idea. Then it goes up, and everyone goes, oh, Phil, you're an idiot. You went up, and then it starts going down again. And meanwhile, this is usually what I'm saying to people, oh, have faith, or now's a good time to double down, or whatever. Because you can't tell from looking at the chart whether it's going up or down. It means nothing. What means something is how good is the company? How is it performing? So, you know, if you look at the chart of Tesla, which, oh, damn it, every time we do the same thing, right? Where's my things? I have to open this tab. I got to put that, I have to make that a permanent thing. So, you know, this is the problem with TA people. All right, because you look at Tesla, and here's an entire period where everybody's like, oh my God, they're doomed, and then all of a sudden, oh my God, it's the greatest company of all time, and then they're doomed again, and now they're great. Charts don't tell you anything about a company. Okay? Fundamentals tell you about a company. And the fundamentals, you have to analyze it and say, okay, what's realistic, okay? And when we looked at this back, whatever this was, oh, now I lost my place. Anyway, when Tesla was like some crazy number, I hesitate to say the number because it seems, I'm not even sure it's real. Let's see, where were they? I mean, look, when Tesla started, we were long. You know, back here, we were long on Tesla. I loved the idea of this company at $30. And it took a long time, and then they suddenly took off, okay? But when they got up to $250, I was banging the table to short them. And yeah, I was wrong for a while. They went up to 270, 280, and everybody's like, oh my God, Phil, I can't believe you shorted Tesla. I'm like, I'm sorry. They're not going to do the bullshit they say they're going to do. Much as I love them at 30, I love them at 30 because they're a $100 car company. They are not a $250 car company. Still not. Even this much later, they're still not. And it's just insane. I mean, these run-ups have been crazy in this stock, and people are just completely unrealistic. So, getting back to your question, which wasn't on Tesla at all, but became the example, Ford. You're asking generally about the auto thing, right? So Ford is languishing, but the auto cycle itself, okay? What drove the auto cycle? What drove the auto cycle was auto sales by quarter. Car sales, monthly, quarterly, annually. Oh, that's wonderful. Google is the best, right? The internet is the best. Imagine if we didn't have the internet, we wouldn't know anything. Well, actually, it's funny though. I used to, you know, this kind of stuff, what I do now, would not be possible without the internet, of course, because we used to do this stuff. I used to do this kind of analysis, but someone asked me a question like you just asked, and I would say, okay, I'll get back to you after the weekend. Yeah, I gotta go look up like 50 things. Damn it. Even so, there's not like an immediately available good thing. Maybe before I looked at the pictures of using numbers. This is not useful. Anyway, sorry about that. Oh, vehicle sales. Maybe this will tell me something. Oh, monthly. Damn. It's too short term. But anyway, look. No, this isn't going to tell you anything. Can we get a bigger number? Quarterly sales, annual sales. All right, let's go to annual sales. There you go. Now we got something. Damn, this stuff is cool. All right. Okay, so what happened? I don't want to say 2006 is normal, but let's say normally, worldwide demand was 70 million, okay? And then coming into like 2006 and 2008, it went down a bit. So here's a couple of years where not too many people bought cars, where instead of 70, you're down 3, and then you're down, then you're down 6. Okay, so now you're 9 million short in 2 years. Cars still need to get replaced. It's just that people put off replacing their cars. Okay, so they still need 70 million cars, the average here, and plus you expect some growth over time as population grows too and all that. So there's still growth over time. There's other factors involved, like India has a really growing economy. They're adding a lot of cars. China's adding a lot of cars. So the 70 million number is probably 75 now. But all that really happens is here you were down 9, and here's additional 3, here's an additional 6, and it extrapolates up, and people who had put off replacing their cars with all these incredibly low interest rates start refinancing their cars and changing their old cars for new. Plus all the new cars get better mileage and so on and so forth. So you get this growth over time. Now, all it's doing now, but here's the problem. This is a problem. Artificially low interest rates. So this is normal. 73 and 76, that's normal because it was added to this. But what kicks in over here with what has to be at least 10% more cars than normal is that the incredibly low financing rates that are artificial make push an extra X amount of people into buying cars. Okay, whether you had an old car, you finally say, oh, at this price I can afford a new one, or whether you had or you had no car and you're a first-time person in India or China or something like that, saying, oh my God, let's buy a car. Don't forget, you're talking India and China are 2 billion people. Let's say 400 million of them are middle class, at least what we would call middle class in that range. So their top 10%, we would say at least is middle class Americans. So there's, what I just say, 40 million? 400, there's 400 million potential additional customers for auto sales. All right? So they start coming online, buying at a rate of, even if it's 10 million a year, it's going to take 40 years for them to all own cars. So you're talking about a really long cycle. Now they're not a car culture, blah, blah, blah. So, but you're still saying there's got to be 40 million of those people who really want a car. And so over time, you're going to satisfy that demand. So this is probably 70-something, 75 is probably normal. And here you have just a little bit of extra growth from some of the developing nations coming online with cars. We don't know what the new normal is. But what's going on now is that we're a little bit shy of, this number was here, we flattened out here, and now maybe we're down a little bit this year. I don't know what the actual number is, but it's not a pattern. There's no drop-off. What we have is we had explosive growth, and now it went down a little bit. But meanwhile, what you got to worry about when you're looking at Ford is how are they in this mix? Because Ford's not selling 87 million cars, right? Ford's selling 10 million cars or 15 million cars or whatever in that group. So Ford has their market share, and they'll gain and lose with the entire industry. But it's not the way you value the company. I want to know how much are they making per car they sell. It's funny because back in 2009 when the market was crashing, and GM was one of the, you remember Kirk Kerkorian was like going to save GM or whatever the hell he was going to do, and I was on TV and I'm like making this speech and I'm talking about GM and I'm like, look, the bottom line on GM, and I think they were like 40 at the time, they went to pretty much 0, and if we hadn't bailed them out, they would be 0. Actually, they technically don't exist anymore, so. But I said, look, the problem with GM is it's that they lose. I mean, I said, look, they made 20 million cars, and they lost $400 million, $400 billion, or whatever, $40 billion. And I said, they're losing $20,000 every time they sell a car. The only solution for a company like that is to stop selling cars. Don't not sell more cars. If you're losing $20,000 every time you sell a car, selling more cars is not going to save you, right? So with Ford, I don't care if the overall automotive market shrinks. I care what their share is, and more importantly than that, what their mix is. If Ford sells more trucks and they sell less cars, less economy cars, if they can get away with it under the mix guidelines. But if that works out for them, then great, because they make more money on trucks. So I don't care if they sell half as many cars as long as they're all trucks. So you have to look at that, but we're not in a late cycle. We're in a normalization after a pump. Now, where you're going to have trouble for the auto business, though, is that obviously if rates start going up, just like the housing sector, then the cars get effectively more expensive for the consumers, and business should slow down, theoretically. We don't know what normal is anymore, though, because you had an artificially depressed cycle from the crash, when basically everybody held on to their used cars because they said, screw that, I can't afford a new car. And now you have an artificially inflated cycle from all those people who put off buying a car coming in and getting cars. So we don't know what real is. And again, you have that outside factor of people in China and India starting to get cars. Here you go. In fact, Chinese auto sales. Let's see. Chinese auto sales. There you go. Oh, how lovely. Look at that. There you go. So, get away. I don't want a premium account. I don't even know what you are. Let's see. So here's Chinese sales. Look at that. Now, see, here's the thing. In 2008, again, you can't tell because the market crashed, so who knows what it would have been. But in 2008, they were at 7, then they went to 10, then they're at 13, 14, and then they hit 20 last year. And here, I have to assume this is probably from at least July. It's got to be July data. So halfway through the year, they're at 13, so they're on the way to 20 again. All right, so remember what we said before. There's 10 million extra cars being sold, but half of them, at least half of them right here, are Chinese. And it's not going to go away, because that's like saying that, that's like being in America in the 1960s and seeing 20 million cars being sold and going, oh, it's a fad, it's going to fade out. Like, what kind of idiot thinks that? It's like, oh, these autos, people aren't going to keep driving autos. They're going to go back to horses. It's like, it's not going to happen. So you have to understand the overall trends and where everything is, and that's when you can make a decision. So meanwhile, bottom line is, yes, I like Ford down here. So Ford is a great company. In fact, and I don't see them performing spectacularly. I think the auto business has growth issues ahead, but I don't care. What I care about is, will Ford survive? That's okay, because this is what I'm trying to teach you guys. Very important thing. Learn to trade so you don't care if it goes up or down. So Ford is $12.35. They pay a dividend. I don't feel like looking it up, but I think it's probably like 4% or 5%. So you want to own the stock for the dividend if you can. And yes, you can, because look at this insane option pricing on Ford. This is why I love them. In fact, we're going to add these guys to the long-term portfolio. If we don't have them, do we have them in the long-term portfolio? Dun, 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 dun. You know what? I had to apologize to the girls who do the who log in these webinars, because I am all over the place, aren't I? Sometimes it would be nice if I stick to a topic. Because I know when they meet the summaries with all the timestamps and everything like that, it's like there's so much stuff going on. Anyway, so the long-term portfolio, Ford. That's what the question. No Ford. Ford. Here, we do have some Ford. So when we bought Ford, it was $12. So this is kind of where we like to buy Ford. And what we did is we sold the 1175 puts and calls. And that's a good trade. In fact, that's still technically a valid trade. But conceptually, so we didn't buy Ford, and we 2,000 shares for $24,000, which is a half allocation for us. And of course, obviously, if it gets put to us at that price, though, we'll have double that for like $40,000 worth of Ford. So we like Ford. We like Ford so much we're willing to commit to owning $40,000 worth of it, which is 5% of the portfolio, right? Yeah, we're at $1 million. Okay, so it's 5% of the portfolio, which is only 2.5% of our buying power. So, you know, not huge, but we like them. Anywho, dividend. And they pay a dividend, which I like. All these guys, obviously, we wouldn't have a stock if it didn't pay a dividend. So where was I? Oh yeah, Ford. So basically, it's not too far from where we liked them in the first place. But I'm sorry. Here's the important point, though. I don't care if Ford goes up. We already sold it for $11.75. Now we're going to roll this in reality when we get to 2018. We're going to probably roll to another set of puts and calls and collect more money. But I collected, $8,000. I collected selling these puts and calls. We bought them at 12. We're going to sell the thing for not 12, $11.75. I actually was bearish, not bearish, but I certainly wasn't bullish. I was conservative when we picked up these shares because I thought they'd have a rocky road ahead. And lo and behold, here we are, you know, not too far off my mark. So back in February, I thought Ford wasn't going anywhere. And so we sold the $11.75 puts and calls, collected $8,000 against $24,000. That's 30% right there. So we collected 1/3 of what we paid in short puts and calls. We're getting the dividend for another whatever the hell it is. And then when time comes, we're going to sell it back for $11.75. But we're not really, because what we're going to do is roll these out to 2019 or 2020, and we'll collect another $8,000, so we'll get another 33%. So we're really in this trade to make like 15-20% a year. That's the purpose of a conservative trade like this. And I know it's weird when I say conservative, 15 to 20% a year, but it is. That's just, you know, we're very well hedged on this trade. And the worst thing that can happen to us is we own more Ford cheaply. So unless we think Ford's going bankrupt in the next 5 years, it's a great trade. All right, so getting back to Ford now. It's at $12.35. So what I'm saying to you is don't worry about whether or not they do well. All you care about is that you can buy it for $12.35. You can sell the $12 calls for $1.45. Okay, so that's $1.45, and all right. Well, I don't have it. And then these are all right. These are $1.60. So let's say that's $3, just for whatever. So you sell the $12 puts. And you can go lower if you want, but I mean, basically you can sell the $12 puts for $1.60, these for $1.45. That knocks $3 off your purchase price. So you're effectively buying the stock for $9.35 or $9.30 or whatever it works out to. If you get called away at 12, which is where it is now, you're going to make $3, 33%. Plus, you'll collect a dividend along the way, which is another, you know, like I said, 5%, whatever. So you're going to end up with 30. You got 33% plus at least 4. Well, obviously 4 payments, but let's say 5 payments of. So call it 5%. So you're going to get 38% between now and next January, which is only 16 months. So that's great. What more do you need? I see this is the thing. People say, "Oh, couldn't I sell the $14 calls instead because I think Ford will go up?" I'm like, I don't care if you think Ford will go up. Why do you need more? Why can't this be a safe trade? Why can't you be happy with 35% in 16 months? Why can't you say, oh, you know what, 2% a month, that's good, I like that. Why do people have to be so greedy? It's really nice in your portfolio, because we haven't mentioned Ford. We haven't talked about Ford since February when we bought it. I wasn't even sure it was in my portfolio. We haven't thought about the stock since February because it's been fine. It's on track. That's all we care about. Is it around 12? Great, it's around 12. Is it 14? Who cares? We sold it already at 12. It doesn't matter. It's nice to have stocks that make 30%, that make 15% a year, 20% a year, that you don't worry about. Your whole portfolio should be like that. If you can, and that goes back to stuff we talk about in our video series and stuff, in the education section on our site. If you can consistently make 15 to 20% a year, you are going to be a very wealthy person, unless you're only going to live 5 years. But anything over 5 years, you're going to do really well. At 15 to 20% a year, you're going to, even in 5 years, you will be double in 5 years. In 10 more years, you're quadruple, right? 5 more years, you're quadruple. So 10 years from now, you have 4 times more money. And these are safe trades, very conservative, okay? I mean, yes, it could go down. You could end up owning more Ford, but as long as it's a blue chip stock that's going to survive the downturn and come back over time, it'll be a minor setback to you. These are things that you can ride out. And you don't overextend. You never want to overextend. Because frankly, if Ford went down to 6 again, or whatever it was in the crash, I would be happy to double down. And so you have to do a good portion that's sensible. Like I said, there's 2.5% of our buying power. But I don't mind going to, and I wouldn't, by the way, don't forget, if it goes to 6 and I double down, I'm not spending another 2.5%. I'm spending 1.25% more to double down because it dropped 50%. So now I'm still not even in for 5% of my portfolio, and now I have a ton of Ford. But again, I don't want a ton of any old thing, but I want a ton of Ford because it's a freaking blue chip auto company that only the most psychotic Republican wouldn't bail out. And I'm not even sure if they could do it. I mean. It didn't, the ball wasn't in Bush's court at the time. The ball wasn't in Bush's court. That's not the right thing. Anyway, the ball, that expression sounds wrong. Anyway, the ball was on his hands at the time. It went to Obama, and Obama said, screw you, we're bailing him out. They didn't move to bail out the auto companies. They were dithering about it when it was happening, but And by the way, Ford wasn't even one that actually needed bailing out so much as the other guys. But it's a well-run company. They've been here forever. They adapt with the times. They've gone through depressions, recessions, and everything else. It's the kind of stock I don't mind owning long-term. And long-term, I mean 20 years plus. It's a stock basically my long-term portfolio, I like them to all be stocks I can imagine giving to my children. And getting to my children, meaning my kids could care less about the stock market and maybe never will their whole lives. So I like stocks that they don't have to think about. I want stocks that any moron can manage this portfolio and make and make a steady return for them. Because this is what I'm leaving to them when I die. Maybe, not this exact mix, but I'll die at some point, and the stocks in my portfolio are going to be the stocks that they basically have to work with. And I want them to be by that time, I expect to have a huge portfolio of nothing but dividend-paying stock that will just keep giving them money, and they won't even know why. And be like, just put this in a trust, close the trust, don't touch it, and dividend checks will come to you, and that'll be your income for life. And then their children's income and their grandchildren's income. That's the kind of companies that I like to have in a long-term portfolio, not faddish stocks. All right, there's question number 1 out of the way. So we laid the business cycle. No, I don't think we laid the business cycle. All right, well, now we can go back to this. So this morning in member chat, we were talking about what did we talk about? A lot of stuff. All right. Somebody asked me about the velocity of money and stuff like. Oh, I see. I made a comment. Here's the thing. I made a comment. Because we were talking about the dollar and the value of the dollar and so on and so forth. So my initial comment was, I think, look at this. Look at the velocity of money. Since 1995, it went down and down. It went crazy up due to, in the dot-com with the internet and all that stuff coming around, things changed. And the natural velocity of money went higher. Plus, we had a boom and all that, and the economy was booming, so there's a lot of reasons why. Then it normalized, and it's not because of 9/11. Here's 9/11, basically. It wasn't because of 9/11. It was going to normalize anyway, but it's going to normalize at some higher level, probably in this range. So, because of computerization and microtransactions and the third world coming online, things like that, a lot of factors, the velocity of money is shifting up on a regular basis as we digitize our economy. It makes it easier for money to move back and forth fast. So the velocity of money was generally in an uptrend, and I think, to me, this is an uptrend, even though that's down, it's still an uptrend, and it's an uptrend that goes this way. Okay, but then we had our crash, and this is what a depression looks like. I mean, people are just not spending money. Money gets in someone's hand and it dies. Velocity is nothing. You get money and it ends. Velocity money can't be zero. 1 is the lowest it could be because 1 means you get money and it stops. There's no second transaction. So, when the velocity of money, so in other words, the average money changes hands at X speed. It's a weird sort of thing they do a calculation. But conceptually, the money just dies in your hands when it's this low. People get money and they don't spend it, they don't do anything with it, they save it, they stick it in the mattress, whatever. So, and you can see here, way back from the 70s, so this is normal in a non-digital society. Okay? Then we develop a digital society. We don't know for sure where the new normal is. I just think it's probably up here. I think it's probably just a bit up higher. But at that time, the economy collapses and people get depressed and don't spend, and there it goes. So to combat this, the lack of velocity of money, the Fed increases the supply of money. And that's the QE monetary, that's the Fed's internal supply. This is the actual stock of money in the economy. From 2000, from the crash, we're at like 7,500 to here, almost 14,000. They've almost doubled the supply of money since the crash. That's, as I said here, cray-cray. My daughter says that, which I think means crazy. I'm pretty sure she means crazy when she says it. Hopefully it's not something else. But that's just nuts, okay? So then someone asked about the velocity, and basically, in a nutshell, that's what we were talking about, like what happens to money and what happens when the money goes to this person or that person, whatever. So what was the question? I forgot now. Business cycle, right. Oh, yes, there's the point. See, I knew I had a point. So here's my point. Oh, we were doing some calculations. Where did I do those calculations? They were cool calculations. GDP. Oh, I think after that I started thinking about it. Nope. Damn it. Oh, it was right there. Okay. So then I started doing some calculations. I said, look, the velocity of money is kind of like the GDP. The velocity of money times the money supply, right? So 1.4 times 13. 1.4 velocity times 13 trillion dollar supply means you have $13 trillion moving at 1.4x equals 18.2, which is our GDP. In 2010, it was $8 trillion times 1.73, which was 14.5, and our GDP was 14.9, so it's almost exact. And as you go back, it's not because they adjusted for inflation and so on and so forth. But the point being that that's the relationship. So here's the problem, though. The Fed created all these dollars. And they do that by printing them out, by buying, they create money and they buy bonds. How do we explain this? Okay. Your grandmother 30 years ago bought a treasury bill for $1,000, right? and it paid 10% interest for 30 years, and she was very happy. And every year she gets $100, and that's how it grows and whatever. All right, so she bought this 30-year bond 30 years ago, whatever. That money that she gave the Treasury got used by the government and spent and so on and so forth, right? So that was money the government borrowed from your grandmother, and they took it and spent it on whatever, mostly on military crap. So here we are 30 years later, and your grandmother doesn't have $1,000. Okay? She doesn't have $1,000 to buy another bond. But the Federal Reserve buys the bond from the government treasury by creating money. How does the Fed create money? This is an interesting concept. You need to know this. This is the greatest thing on earth, actually. The Fed has a checkbook that's like magical. And the Fed's checkbook is backed by their assets. So in other words, what they do is they assign a monetary value to their assets, and they say that's how much money we have, right? So, by a very small leap of faith after that, you say, well, if the value of if our bank balance is whatever assets we have, and usually those assets are our T-bills and things like that and whatever that the Fed accumulates. So if the value of the Fed is whatever the T-bills is, and they could write checks against however many T-bills they have, right? Then logically, if you buy another T-bill and it's going to go into your bank, and it's going to get added to your asset pile, then can't you kind of spend that money that you're going to get to buy the T-bill? You don't have to purchase. This is the kind of logic like Bugs Bunny or Doctor Who will use to convince aliens to leave the Earth. It's like okay, so you follow me on this far, right? Okay, so if I had the money, if I had my $1 billion bond in my vault, I could then write you a $1 billion check, correct? And I was like, well, of course, if you have a $1 billion bond, you could write me a $1 billion check. So I'm like, well, so I don't actually need to have it. So if I write you a $1 billion check now and you give me the bond and I put it in my vault, then I have it. And the guy's like, It's like, well, I guess so. I mean, I guess you can look at it that way. That's the logic. That's how the Fed actually creates money. They buy something with money they don't have, but then they count the thing they bought as something that's valuable that they wrote the check against. That's how they make money. So whenever the Fed wants to, they just buy assets and add it to their collection. That's why and here's what they did. They bought $1 trillion, $2 trillion, $3 trillion. It's like guy in Sesame Street, right? Like $1 trillion, $2 trillion, $3 trillion, and it's like $4.5 trillion now. Their asset base. So they've written $3.5+ trillion worth of checks and created. That's how much money the Fed has created, and there's a natural creation of money that goes on as well. So that's where you get this whole money stock. But the Fed has added an unnatural $3.5 trillion to this pile. So from here to here, this portion here, is the Fed. And then a little bit is the natural progression of money. So, there's this incredibly gigantic pile of money. Just imagine trillions and trillions of dollars. And they're sitting there not moving because there's no velocity of money, right? Now, if, hopefully when, but let's say if the economy does actually pick up, and there are signs of it because we're raising wages. And I've said forever that the only way you're going to ever fix this economy is to start paying people so that they have money and then they can go out and spend it. And that is finally starting to happen, even though we had to enact laws to make it happen. But we're finally raising wages. And raising wages puts more money in people's pockets, and those people are those are poor people who actually spend their money. And by poor, I mean the bottom 80% of this country. Those are poor people who actually spend their money when they get money, and they're using it. That's how the money supply, that's how the velocity of money increases. So then the multiplier of this gigantic pile of money, if it moves up even slightly, and I calculated, okay, so I said, what if the velocity of money goes from 1.4 back to 1.6, just there, tiny little bounce. Look what happened here. This is 1987, and that's 1990. That's a 2-point move right there, basically. So I'm saying, what if it just goes back right here to 1.6? Then you take the one. Now the problem is, then you got the 1.6, right? You're not changing the supply. So 1.6 times 13 is $20.8 trillion. That's a 15% jump in GDP. That's like China kind of growth. That's like that's essentially hyperinflation at that point. That's like crazy fast growth. Even if it takes us 3 years to get there, that's crazy fast growth for this size economy. All right? So there, in a nutshell, is my bullish premise. The Fed has a very hard time putting that genie back in the bottle. The money is out there. Okay? They don't have anything that they can take away. In other words, it's not like they can just shut down the money supply. The money supply is in people's hands. They gave that money, when they buy $1 billion worth of bonds, they give $1 billion to the government. The government sure as hell spends it. Obviously, the government spends more than they have all the time. So the government spends every penny you give them. They're like a poor person. They spend all their money. So that's out the window. And that money is in goods and services and so on and so forth. The Fed can't come and say, oh, time out, I want to take back $1 trillion. There's no mechanism for them to do that. All they can really do is they can raise the reserve requirements of the banks and require the banks to absorb some of the money by having more reserves on hand. They can do that. And they can also increase the rate, the borrowing. They can increase the rates and cause more money, people to put more money into banks. But at these rates, who's putting money into banks to save it? So it's going to be very, very hard to suck up that money supply. And if they can't suck up the money supply, I'm sorry, the Fed was counting on a housing boom to come about and suck up the money supply. But here's the problem, and probably a lot of you guys can relate to this. I can relate to this. When I bought my house, it was $400,000. This was like 20 years ago, and I put I built a pool inside. I put a lot of money into it, but that's irrelevant. I put money into it. I obviously pay my taxes, pay repairs, do stuff, blah 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 blah. Now, when I bought this house, I expected it to be a return on investment, and in fact, in 2006, somebody offered us $950,000 for this house. And I wanted to take it. My wife didn't, so we're still here. But I wanted to take it. I was like, that's crazy. But at the time, that was how fast houses went up, and you expected that. Not you didn't expect that, but I expected it to be worth $600,000, $700,000, $800,000. It's not though. My house is back down to like $6 maybe. 20 years later. And with all I put into it and so on and so forth, I'm breaking even best. Now, a lot of people are behind on their homes. A lot of people are upside down, or they're barely going to break even getting out of their house. Or they're not even going to get their deposit back. That's the thing, breaking even. If you're breaking even selling your home with the mortgage to pay off your mortgage, and your mortgage is still whatever it is, if you refinance or did whatever, you get nothing when you close your home. Where do you get the money for the next house? So more and more and more people are renting, but it's not just that they're renting because they don't have money. It's that people are renting, millions and millions and millions of people. There are 110 million residential homes in the United States. Of those, probably they turn over on an average every 20 years, let's say. Okay, so let's say 20, probably 15. So let's say 15 years. So basically you're on a cycle of 15 years. So anybody who bought a house, though, since the 1990s at least, or even in the late 80s. Certainly in the 90s anyway. If anybody bought a house in the 90s, till now, 20 years worth of buyers, which means a good portion of the people who own a home got burned, didn't make any money, and they see their house as a money pit, and it was a bad experience owning a home. So they're not just renting for economic reasons, they're renting because they think owning a home sucks, and it's not a good deal, and it's not the American dream. And they don't want these giant houses that cost a fortune to take care of. And especially, oh, and by the way, the worst thing that's happening is the government raises your property taxes, right? When I bought my house, my property taxes were about $4,000. Now they're $20,000. My property taxes now are more than my mortgage used to be. That's sick. How does a person retire? How does an old person who's buying a house, they're like, oh, in 30 years we'll pay, that used to be a dream, right? In 30 years we'll pay off the house and we won't owe any money and we can retire and be happy. No, not if your mortgage has been replaced by a tax bill and your utilities go through the roof and blah, blah, blah. It's a nightmare. So there are 20 million, 30 million, 40 million people in this country, I'm talking like 30, 40% of the potential homeowners who wouldn't buy another house if you gave them the money. That's the problem. And that's why we just had, like today, the existing home sales numbers were terrible. Because existing homes are big, dinosaurish houses. New home sales are doing pretty good because people are buying small little apartments and saying, I don't need this much. If I'm going to buy a house, I want to buy the littlest house possible so I can't get screwed. That's the new trend. So, but anyway, so that's the Fed's problem because the Fed thought that the housing market would come back. What's happening is we're still in a very slow motion collapse of the housing market. If the Fed dares to raise rates, housing prices will collapse. The only thing keeping housing prices up now is the Fed keeping rates this low, so your net mortgage payment is fairly low. But if the Fed raises rates, don't forget, we're trying to sell houses at 3% now, and nobody's buying them. If you raise the house price to 4%, you're effectively adding, I'm going to guess, 25% to the mortgage payment. At least 20%. So, if nobody's buying now, and the price goes up 20% of the mortgage payment, what's going to happen? The house price is going to have to come down 20% or no one's going to buy it. So that's a catastrophe that will continue for many, many years to come. And the Fed, if they raise rates, in any kind of serious manner, it's going to totally crush the housing market. Because these people who are renting aren't renting just for now; they're never coming back. Millions, tens of millions of people will never buy a house again. Just like in the Depression, your grandparents or great grandparents or whatever they were, they had these habits from the Depression. Like picking up pennies and things like that and whatever, and like keeping jars and whatever they did. It's like all these weird habits that you're like, oh my God, you're so cheap or whatever. You're like, are you crazy? It's like, who saves toilet paper rolls? It's because they went through a time where that actually mattered. And it was a shock to them, and for the rest of their lives, they just can't break that habit of being careful and saving. And it takes decades for that to change. And that's where we are now. We have destroyed a decade or 2 decades worth of homeowners who just will never come back to this market, never. Because it was so traumatic and so awful and such a financial disaster for so many people to have bought a home and bought into all that crap that they told you at the time that this was the best investment you could make and this is blah, 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 and whatever. Total bullshit disaster. And it's the fault of the real estate industry. They were pushing people into homes that they shouldn't have in order to make more sales. All right, so anyway. So that, now, contrary-wise, despite feeling that way, that still goes in hand with what I'm saying about the economy, though. you still can't get away from this. Okay, when the money starts moving, now all these people renting, it actually is better to rent. You don't have all these idiotic expenses that you own a home. These people have more money, more disposable income. They're starting to spend it. It's moving through the economy. You're seeing signs of it now. So the velocity of money is picking up and will continue to pick up. You don't need home sales to pick up the money supply. In fact, they do the opposite. So what you're going to have is this money multiplier is going to go faster and faster. The money won't be sucked up by home sales, and you're going to have very shocking growth. It'll be inflationary growth. It's not going to be real growth, but it's inflationary growth. But it doesn't matter. The bottom line is you're going to have a higher GDP, more money, so on and so forth. So that's good. Long-term economic outlook is good from that perspective. It doesn't mean we have a healthy economy. It just means that in the measurement that we care about for this purpose of the stock market, it's good because there's more money. And obviously you want your money in the market because you've got to keep up with the inflation that's coming down the road. All right. Whoa. The time is... It's 2 o'clock already. Holy cow. All right. So, your trade idea for Exxon, please review. Is there possible? No. We're done. No, Exxon's out. They did exactly what we thought we would do. We terminated the trade in August, and we're done with it. Yeah, in fact, they basically topped out dead when we wanted them to. 30, that's all we ever expected them to do. We're done. The whole thing was timed because of the Olympics and Zika. It was a good trade because that was our logic. We said, look, they have the Zika thing. The Olympics are in August. The mosquito season in the U.S. is in August. The Olympics are in August. They're going to be in Brazil. People are going to be talking about Zika. They're going to look for Zika stocks. Exxon's name is going to come up, and it'll go up. That was our logic in June. It did exactly what we thought it would do, and we're done. Because honestly, their solution, which is to introduce Exxon's solution to Zika, is to introduce all male mosquito. They introduce mosquitoes that only produce male offspring. So male mosquitoes, and when they mate with the females, all the offspring are male. So eventually, the amount of male mosquitoes just completely outnumbers the female mosquitoes, and the whole population dies off. That's how they control mosquitoes, in theory. Now, the repercussions of this down the road, who the hell knows? You know, we've never purposely committed genocide on a species before. I won't say that. We probably have, but anyway. So just to sit there and have a solution. It's very hard to get that passed and to have environmentalists and everyone get behind that and say, okay, this is what we have to do. Now, if you have thousands of cases of Zika and babies with horrible, deformed heads and whatever, then yeah, they'll pass whatever. But next year, because this year it's too late now. The mosquito season's over in the U.S. Everybody's attention is going to go elsewhere, and Exxon will probably fade out. Next, coming into next spring, next summer, it might be time again to start looking at this stuff. Anyway, so I'm done with that trade basically. Self-driving cars are going to enable people to share cars more easily. It won't make sense. I agree with that, and in fact, I think what Apple's working on is creating car environments. So in other words, like when my daughter goes into my car, it syncs with her Bluetooth on her iPhone, and she has total control of all the media in the car. And I don't use my Bluetooth because it makes them happy, so I could care less. All I do is listen to like 2 stations. So it's not like I care. She's there being a DJ when we're driving. So the point being though, that if you imagine it, you take that a step further, and basically when you walk into a car with your phone, the car can sync to your phone and have all your preferences, how you like your seat, how you like your temperature, how you like your music, so on and so forth, okay? In addition to where do you want to go, whatever, it is all through your phone. So Apple sees this. What Apple's working on is not a car. Everybody thinks Apple's working on a car. Apple's working on a system for cars that will be in the car so that it'll be an Apple a car with an Apple feature that Ford, GM, and everybody else will stick on their car and say Apple Environment. And that way they'll sell it. So instead of selling 1 million Apple cars, they'll sell 30 million Apple Environments, 4 cars, at much higher margins. So that's kind of what we, so that's going to be self-driving cars. So yeah, what that means though, obviously, is it enables self-driving cars, because when I call a self-driving Uber and it shows up configured the way I like it, I'm fine. That feels like my car, and I'm going to be a lot happy with it. Now, it's going to be interesting. It'll be interesting because what you're going to need, or you might want to actually invest in, if there's a car wash place by your house that you could see like that needs a very large parking lot and room for expansion, because that's going to be very important. People are going to want clean self-driving cars. When somebody gets out of a self-driving car, how is it going to be clean for the next person? Okay, there has to be now, it's possible the car can check to see if it's clean, but eventually they need to be cleaned on a pretty regular basis. So that kind of business, something it has to be, you have to imagine how are self-driving cars going to come to my car wash and get through quickly and cheaply, and what can we do to just basically give it a quickie inspection that we can charge like $5 for, $2.50 for, something like that. You have to come up with an incredibly low price where you can zip a car through a thing, give it a quick rinse or a quick vacuum, and gone. Because that way, and you can, because then a car company, self-driving car company, can then go through these certified shops. And logistically, there aren't, if you can build it cheaply by buying up car wash places, and do it has to be done dirt cheap. They're going to go for the lowest cost providers on these things, but it's going to be a nice business. So, but yeah, I think the whole thing is going to happen, because look, there's no reason to own a car. My daughter doesn't even want to own a car. She's pissed off because some of the Uber drivers won't pick her up because she's 16. She doesn't. You're supposed to be 18 to use Uber, but they don't. Most drivers don't care. Some drivers do care. Go away. Okay. So anyway, so yeah, I think that's going to change, and that'll probably also be a difference for the car industry for sure. All right, but on the other hand, all the self-driving cars, you still have that 400 million people in India and China. So it's going to be a long time before the auto industry is in trouble from that kind of stuff. What will happen in the stock market when interest rates rise? When interest rates rise, like I said, when the Fed starts picking up the rates, it'll certainly hurt the market, because all these companies that are borrowing at these incredibly low rates will have to roll over at higher costs, and loans get more expensive. They won't do as many buybacks, so on and so forth. So, it's all part of the reason why I just don't see the S&P going higher than it is right now. I really don't. I think we're way ahead of ourselves on anticipating the growth of this market. Now, long term, I think the economy will grow and we'll be fine. But I just don't see any major explosive growth from this at this point right now where we are, until things sort of normalize. Like next year, and I said from the beginning of this year, I said we'll be at 2050 this year. That was my goal for this year was 2050, 2100 tops. We're over that at the moment, but barely over it, and the year's not over yet. So my range is still good. I haven't changed my mind about my range. Next year, though, 2200, sure. I like 2200 next year. But this isn't big moves. I mean, look, we're at 2200 practically today. So I'm not predicting big moves. We're where we should be. This is about where we should be given this environment. And there's going to be good things and bad things as we move forward. But they have to raise rates, and that's always going to keep a lid on things for years going forward. They can sell their bonds in the market. No, they can't. That's funny. Who are they going to sell these bonds? Who are they going to sell $3.5 trillion worth of debt to? Our government only sold $1 trillion. No, this year they only sold, our government sold $600 billion worth of debt this year, and they sold it to the Fed. There's no people buying this crap. Human beings don't buy notes at 1.5% for 10 years. There's no market for these bonds. So they can do it, they'll take a tremendous loss. And you know what happens when the Fed takes a loss? It goes to Treasury. Treasury has to pay and cover the Fed's losses. That's why they have their magical balance, their magical checkbook. Because they can't lose money because the Treasury is obligated to make them whole on anything they lose. That's why they mark all their assets up to 100%. Doesn't matter what the asset is, the Fed is going to get covered eventually. They can stop buying. They can stop buying new bonds when the old ones expire. That's right. Right now, they're still every month they buy $60 billion worth of bonds. They're rolling over their debt. They're not. So QE hasn't ended. They still put another $60 billion in every month of money. That's still coming in. If they stop doing it, yeah, but you know what? If they stop doing it, then if the Fed doesn't buy the bonds at these ridiculously low prices, then you're going to have to price the bonds at a level that people will actually buy it for, and that's going to knock rates like flying higher and cause a massive crisis. So they really can't stop. They can't stop until there's actual demand for bonds, and there's never going to be actual demand for bonds if the bonds pay 1.5%. We could end the Fed, have the Treasury, print currency, debt-free currency. Yeah, no. It's not going to happen. Our webinars are always on Wednesday afternoon. Yes, well, yeah, I hate the word always, but yeah, pretty much yes. Wednesday at 1. What's a good industry that what's a good industry that will form the infrastructure of self-driving cars? Guidance system, let's say. Laser vision, where do you think the new? Like I said, my favorite play on self-driving cars is to buy car washes. It has to be a good car wash, though. Like there's one by my house, it's got, they're next to an A&P, and the A&P died, so it's got a gigantic empty parking lot next to it. So you want a car wash like that has the ability to intake like a constant stream of cars, because you know, let's say the average person washes their car once a week, right? If you have self-driving cars, though, you really almost every night have to have it at least looked at. It doesn't have to be washed; it has to be looked at. Now, it would be no problem at all for any of these, the Spanish guys that work at the car wash, or the Mexican guys, whatever they are. Is that racist? I don't know. They are Mexican and Spanish. If any of those people who get minimum wage, that they're perfectly capable of looking at a car and deciding whether it's clean or not, and they could put a little sticker on it and say this car's been checked on such and such a date. And you know what? If I can get my guys to do that, all right. So this guy, I'm paying $15 an hour to. Let's say we raise minimum wage, whatever. I'm paying him $15 an hour. If he can look at a car every 2 minutes and put a sticker on it. And now, don't forget, his job is, here's his job. His job is to, so you're the car company, right? I've got this guy, and he's going to check your car, and he's going to give it a sticker if it's clean. If it's not clean, I'm only going to charge you $1 for that, because I can have this guy look at 30 cars an hour for sure. So I'm going to make 100% back on this guy's labor, because all his job is to stand there and look at 30 cars an hour, right? So I don't have to charge more than $1 for that. So I'm telling you, the car company, I'm saying, look, most of your cars I'm going to turn back around for $1. And for $1, you'll be able to certify your cars and tell your people they're clean. And it's not one time. It's not per ride. It's for the day. You're saying, oh, this car is certified clean today. And then you'll also help, because the car company will know if they have a bad client who messes up the car. They'll know not to send them cars. So you have your self-driving cars, so I have this constant stream. And then I say to the car company, I'm like, okay, so his job is $4 to certify your car. If your car needs cleaning, I'll charge you $5 to clean your car. And that'll automatically happen. In other words, my guy's either going to send your car along the way and give it a sticker, or he's not going to give it a sticker, and he's going to send it into a wash. It's going to get washed and cleaned, and the guy at the other end will give it a sticker and certify it. But I said, either way, you have a certified car either immediately or within 5 minutes it will go through my wash. And that's my sales pitch to the people who own the car. So that, to me, is a business nobody's looking at that's so obvious it's going to be required all over the country. And it's also a great roll-up because nobody owns these car washes. They're independent craft businesses, right, that nobody owns. They do make nice money. But it's something that you could just start buying up car washes all around in key places in the country and then brand it and then create this thing. But obviously you have to have a leap of faith because you're way ahead of the curve on this thing. But I am going to pitch this to some VC guys. Anyway, So to me, I was like new industries rather than that. Like, so you're looking for investments, obviously. What's a good industry to be infrastructure? Like I said, Apple. To me, Apple is a great. I think Apple. Somebody's going to make interiors to these cars. Somebody's going to make an environmental thing because when you get into a car, you don't want it to be, even a taxi, right? You ever get into taxis? And I especially have this with Uber. It's always interesting to me. Like Uber guys always like. A lot of them say like, well, what station do you want to listen to or something like that. And I'm always interested in what they're listening to because I like variety. I'm just curious. I interview my Uber guys all the time. I want to know like what they're doing and how much they're making and what their life is like. But I'm also interested when they're listening to something. I'm like, no, it's not whatever you're listening to. I want to get a feel for what it's like in this thing. But in reality, my kids though, they want everything their way. Immediately, they absolutely they can't stand being in a car where it's not playing their music and so on and so forth. So, car environments is going to be a big thing, and I think Apple's already like way ahead on that. So I do. We just reiterated an Apple Trade and Chat. As far as the other stuff, all the the Mobileye and whatever. In fact, Mobileye is getting together with one of the competitors. I think they'll buy somebody. They're getting together with another company and forming a bigger thing. So MBLY, I think they are. That's a good little, probably investment. You want people like that. I think that's them. Yeah. So long term, if you want to get play the guts of things like that. But I'm telling you though, the car wash thing is going to be huge. You'll see. You'll see them and you'll say, damn, I should have gone with Phil and given them some money. Processors B. Oh, I see from that. Ain't you taking a dive? What, the markets? We haven't even talked about the markets. How are things looking? I don't see anything. Oh, there they are. Oh, yeah, look at that. Well. Oil and gas are holding on, though. I can't believe this. This contract, they're expiring tomorrow. I can't believe they're holding on like this. All right, so you think the market is fairly priced at all-time highs given the macro environment? I think it's overpriced at this point. I think that a fair price is about $20.50, $2,000 would be a fair price. I wouldn't be surprised to see it correct to like another 10% below that, like to $18.50. But on the whole, I mean, look, and again, understanding like what we were talking about with Ford before, to me, it's like I don't care if the market's up or down 10, 20%. As long as like 2,000 though is a line on the S&P that I think is correct. It's where we probably should be. It's around 2,000. So 2,200 is only 10% over 2,000. We're still in the right range. We're just in the high end of the correct range for the market. Disney. Is Disney discounted? If they're under 100, they're discounted. If they're over 100, they're not discounted. So where are they? BIS. IMAX, we just did a top trade alert for. Oh, Disney, yeah, sure. Oh, nice. I love it when they do that. Yeah, so Disney's a good one. Now see, Disney, yeah, they probably pay a dividend, but I don't think it's much. Disney. How do I get to the actual thing? Go to quote summary page. Very good. Good job, Yahoo, with the button. All right. Yeah, they pay a completely bullshit dividend at 1.5%. So with Disney, I wouldn't own it. See, this is the thing. If it's a stock that doesn't pay a good dividend, I don't see the point in tying up my cash. So with Disney, And I'm sure we already have a plan in the long-term portfolio with Disney. There it is. Oh, in fact, this same play is still available. With Disney, we have the 2018 90 calls, and they're now 12-something. And we sold the 105 calls, and they're 528. So your net on that is like $7. Okay, so it's a $15 spread netting for $7. We also sold the $90 puts. They're at 95 now, so we sold the $90 puts. Those are now $763. So if this nets out to 7 and this nets out to $763, you have a small credit and a $15 spread. Oh, I'm sorry. In this case, though, we did a half. We did a half sale. So basically, this thing nets in for like $3. So we have $15 spread that we net $3. We're obligated to buy 1,000 Disneys at $90,000 worth of Disneys. No joke. Right? But that's our numbers. I mean, you can do 221. You don't have to do the same. You don't do the same math. And if you do 221, it'd be $9,000 obligation. I mean, your net cost though is $3 on this trade, and Disney is you're $6 in the money, so you're in good shape, right? Because you only paid $3 and you're $6 in the money, and the potential profit is $12, which is what 400%. So if Disney goes to 105, so that's how I like playing Disney. The long-term portfolio play that we have now, I still like. And as it happens, these things all cancel out, so it's basically the same price we started with. ADX is down, silver is down. At what point did you consider new entries? When the dollar, very important, when the dollar is back to 100, that's when I like new entries. Okay, until the dollar is back at 100, I wouldn't play gold or silver. I think the dollar's going to get stronger and they're going to go down. Oh, I'm sorry. Exxon is in the OOP. Unless I missed it, would you be dropping now? Would you wait for them to stabilize? Oh, no, we're done with that. I thought we were out of those. Didn't they expire? My bad. Look at that, 86.5. Very good. All right. Exxon. There we go. Oh, October. Ooh. That's my mistake. I thought they expired in August, and I thought we were done with them. All right. Well, I'm not happy about that. I will have to put that into consideration. I no longer have an interest in being in Exxon. So it's a shame because we could have gotten out higher. I think I even made a comment about that the other day, though. I honestly thought they expired in August, and I really thought we were going to be cashed out at that price. I had no idea they were October. Big mistake. That's annoying. These puts I wouldn't do anything with because they'll expire worthless. So that that's going to be you'll collect the full 1,500 there. But these, unfortunately, are currently now a loss. I'm not happy with that. But at the moment, I wouldn't change it. I want to take a look at it and figure it out, and then I'll do a review of this portfolio by the weekend for sure. Okay, what are my thoughts about Low? Who Lowe's? I don't know where they are at the moment. I usually like Home Depot better when I analyze them. They're not cheap. Neither one's cheap. All right, so we look at Low. Okay. Nah. I mean, assuming that's the correct number, I have to look at all the stuff first, but assuming that's right, they're at a 25p. I wouldn't pay a 25p for these guys. They're Coke and Pepsi. There's no growth to this industry. They'll have good times, bad times, whatever. But, I mean, look, you can see right here. Here's your financials. 53, 56, and 59. All right, so yeah, about 5% growth, a little bit better than 5% growth. You don't pay 25p for 5% growth. And this is in an improving economy. If we fall a little bit, they'll go down, and everybody's going to sell the damn thing. So no, I mean I would buy them if they were on sale, because, and the same logic though, I would say, hey, look, it's low and people are going to do this and that. If it was low, yeah, if it was low. if it was down at least here, well, not even there. I mean, if it was, let's say, all right. In fact, here's a good example. In fact, look at this. 53 billion in 2014, right? And here's the profit, I assume. Oh, you have to touch it. 2.2, 2.7, 2.5. So let's say 10% earnings growth, right? Since 2014. So here's the problem with the whole market. Are you going to tell me that everybody playing this stock in 2014, not barely a single person paid over 100, it averaged in the 80s. Let's say it averaged even 90 though. In 2014, all these people were idiots, and they were undervaluing the stock by 50%. Is that your premise? Because the way I see it, we're in a frenzy, and people are taking the same exact stock that was worth 90 here, and I'll add 10% and call it 100, and they're paying 30% too much, 40% too much for it, because the whole market has gotten crazy overpriced, because the P multiples of the S&P have gone from 15 to 20, which is 30% too much. This isn't even 20, this is 25. But point being, everybody's multiples have expanded. So no, I mean, I don't like it. I don't like any stock in that thing. The stocks that we've been buying have been very good PE ratios. The stuff that we're picking up now and deploying some of our long-term portfolio money is we're looking for stocks that actually make money and give us a good return on our investment. This is not a good return on your investment because there's no growth story here. Oh, this is Home Depot, I'm sorry. Let's go back to Lowe's. I'm sure it's the exact same. Here it's the same, basically. So they were 50. It's the same thing. Home Depot and Lowe's have the same profile. They're 50, and so here all these people who bought in the 50s had to be. This is only 10% less earnings than they're making now. So these people had to be insane. What kind of moron sold this stock at $50 when they were making earnings that were worth 75? But I'm saying these people weren't insane. Here's QE. This is QE3, the one that we're in right now. This is the Fed giving out free money and pumping up the market and pumping up the economy. This will end. This is fake. All this will end. And hopefully, normal growth, 10%, 53, 55, 60. Hopefully, the value will sort of catch up at some point because the earnings will grow, the economy improves, blah, 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 and maybe 60 will be the equal point. Not 77, though. Okay? That's not right. In a real economy with normal rates, that's not a sustainable amount of money. You always have to look at a stock and think about, like, would you buy the whole company? You know what I mean? Like, would I take my $64 billion and buy Lowe's? Is this going to be the one business I buy? Am I going to live on that money? Do I think that that business more than anything else is going to be the thing I want to be in, and I'm going to, I can grow it, and I can build capital, and I can make enough money, and I can get a good return. And if you can't, and you can't because it makes 5%. Not 4%. 25. It's a P of 25 means it's making 4%. So you're going to get 4% back on your $64 billion. Is that really what you want to do with $64 billion? And that's true of any of these companies, though. When you're paying a 25 PE, you're getting a 4% return. Why would you do that? You can get a 4% dividend from AT&T, a 6% dividend from AT&T. So why would I give Lowe's a penny? It doesn't make any sense. Okay, low. John says what? Yeah, gold just got a little ahead of itself. I still like gold. I think gold will be at 1,500 eventually. I'm just not sure when. What are your thoughts on Delta? No, it's an airline. Okay, again, here's your problem with Delta. Very, very low rates, very, very low gas prices. Okay, what if those things don't last? What if one of those two things stop happening? Also, you have the rising minimum wages is going to increase everybody's labor costs. And airlines run on razor-thin margins. Also, at some point, somebody's going to notice the fact that they're still charging fuel surcharges when the fuel is half the price that it was when they started charging fuel surcharges. Somebody in Congress should wake up and do something about that. So, no, I don't like any of the airlines. I don't think. Oh, and also terrorism, and also things like that. Just no. An airline, you can suddenly wake up and be 30% down in the morning because the plane blew up. And you don't want that. I don't think the link between strong dollar and gold is near as correlated as it used to be. Both U.S. dollar and gold are in bone. Yeah, they're both fair trade. That's a good point. Yeah, that's true. People run to gold and people run to the dollar. But that doesn't mean that when gold goes up 5%. When the dollar goes up 5%, gold won't go down 5%. No, 5% on gold is only like $75 or something like that. So no big deal, or 60-something bucks. I'm not throwing life in death. I'm just saying, why would I buy it now though when I think the dollar's getting stronger? There is a correlation. It's not as strong as it used to be, but there's certainly going to be a correlation. And in the short term, it'll get cheaper. That's all. So can you walk through an example of a bear trade like Hormel and Home Depot sell calls? Well, I don't have that much time, so I'm not really looking at just doing random examples. We can talk about it in chat, because it's not exciting. You sell calls and you pick up a bear spread. But I wouldn't short Home Depot. I'm not saying I hate them. I just think they're overpriced. And if the Fed keeps giving away free money, they're going to continue to be overpriced. So, there's a frenzy. Look, this is the problem in 1999. The reason people like me lost money, all right, I could stay it out. I wouldn't lose money in 1999, but I missed the entire thing. Because I sat there and people would ask me about a stock, and I'd be like, no. Pretty much everything someone asked me, I'm like, no. It's like, no. And like, what about this one? No. Because they were freaking 200 times earnings, 100 times earnings. I'm like, no. It doesn't interest me. I don't want it. And I was wrong. For the entire year of 1999, I was wrong, and everything doubled. And then the next year, I was right because everything was half of where I said no at. So could I have timed myself perfectly and participated in the upside and blah, blah, blah? Yeah. But I was happy that I said no because, frankly, I had plenty of money when the market crashed and then went and bought stuff. You can't, you can't imagine you're going to time it. Once you start doing that, things could go much higher. That's why we haven't taken a lot of short positions because things could go much higher. You can't stop them. There's no logic to this. Amazon is insane. Google's a bit high. Netflix is still high. Tesla is still high. But what are you going to do? You can't make them go down. Amazon is completely ridiculous, irrational value. We are short Amazon, but I mean, Amazon is completely ridiculous valuation. But you got to have balls of steel to short them. You know, that goes for Tesla and anyone else too. I mean, they could. You saw earnings. There's a couple of them. Best Buy, freaking Best Buy just popped 15%. That's like, why would they get how? Where did this come from? And the reason it's happening, though, is because money. People have nowhere to put their money. So they hear, oh, Best Buy had good earnings. Buy Best Buy quick, because there's nowhere to put money. So an earnings surprise. Look at that. Look at that stick. See, and they did it last August too, though. See, that's smart. Should have realized last August they actually had a good quarter too. Then what happens? Boom, 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 boom. So all these people were wrong. Because if they had waited 4 or 5 months, they could have got it significantly cheaper. But instead, they chased and they chased and they chased and they chased and they chased. And then they said, oh, it's only a minor setback. Look, we're setting up, time to buy. Oh, this dip is bullshit. Oh, that dip is bullshit. See, we already recovered. See, now we're going back up. Everybody buy, buy, buy. Oh, and they go, oh, this stock sucks. I'm never going to buy it again. That's what happened here. They're like, oh, this stock is the worst. It's hopeless. It's going to go to zero. And then all of a sudden it goes back up. And now we're back up here where it was. That's how people trade stocks, because they're idiots. See, for me, I buy the stock at 30. I sell the $30 puts and calls, and I could care less what happens. Don't care. As long as it's somewhere around 30, I'm happy. Much more relaxing way to play the markets. XON Chart. I have no idea what's going on with XON. I guess we can look and see if there's any news. Wow. Wow, that sucks. Kind of annoyed. Oh, look at that. Motley Fool. So nothing happened today, per se. Nothing visible anyway. Just all of a sudden dumped. The Motley Fool gave a bad write-up 5 days ago. Investors should not jump to conclusions. Is there any fairly valued dividend growth stocks? Yes, there are. We just went over a whole bunch in chat on Monday, but maybe you want in chat. Oil should be trending down. What's the latest news? I don't know. I'm doing a webinar, Latch. I don't know. I know as much as you do right now because I've been doing a webinar since 1 o'clock. We were going to look at the thing, though, the Petroleum Status Report. Okay. And I talked about this morning, that, we're exporting a lot of oil. Not a lot of oil, a lot of gasoline and products, okay? We're exporting 1.6 million barrels a day. We're only producing 9.7 million barrels, and we're exporting 1.6 million of them. So that means we're only using 8 million barrels ourselves, and the rest we're sending out of the country. Oh, here's that other oil thing. See this other oil, 486.7, and now it's 490.6. 4 million barrels were put into this other oil. So that's why you have this net build. The net build is from 88.7 to 95.3, so it's like a 6-point-something million barrel build. It's insane. This is a glut. It's a massive, massive glut. We don't need anywhere near this much oil. We need 1 million less barrels of oil per day than the refineries are using because it's going into stocks. Every day, 1 million extra barrels, 5% too much oil. So what is OPEC going to do? Is OPEC going to cut production 5%? That's what they have to do to normalize the market. We have 5% too much oil. That's a fact. And they do all kinds of weird things to hide it and shift it around and move it and whatever. But we have 5% too much oil, and every week it goes somewhere. But it builds and builds and builds. So, and last year, oil was 40.45, and now it's 48.50. It's 20% higher than it was last year. But last year we had 1978295. So what is that number? 100 million. We had 100 million less barrels in storage. This will be my article tomorrow already. We had 100 million less barrels in storage. 120 million, sorry, less barrels in storage last year. That is 2.4 million barrels a week of extra oil. Is that the right number? 100? Yep. Wow. That's 10% too much oil. Holy crap. Wait a minute. Let me do this. Okay. Now I need a calculator. I don't trust my brain. All right. Let me figure this out. We have 2095. Okay. I gotta think I'm doing this wrong. 2095 is our current storage. Minus 1978. 117 divided by 52. 2.25. Wow. Oh yeah, it's not a day, it's a week. There you go. So divided by 7. 3.2%. Okay. So on that count alone, there you go. That's where it's wrong. I knew something was wrong with that number. Didn't divide by 7 because it said it was a weekly number. So basically, we have 3.2% too much oil every week. Yet we're paying 20% more than we paid last year. That's complete and utter scam. We are. Crude oil input to refineries is less than last year. Capacity is lower than last year. We're refining less oil. We're producing the same amount of gasoline. We are producing less distillate. Stockpiles, as we just noted, we're building up. We are supplying the same amount of gasoline, the same amount of distillate, the same amount of other products, yet we're paying 20% more. There's no underlying fundamental logic to that whatsoever. There's no reason oil should be this high. The only reason it's this high is the OPEC thing. And I think the dollar might be stronger than last year. Let's see that. No, about the same. Okay, so the dollar's about the same. All right, so it's not about the dollar. So think about that though, 20% high. So really the only factor here is the anticipation of an OPEC production cut or something. And if they don't do it, there's a 20% downside to oil to hit reality. And frankly, I think last year oil was up on speculation that OPEC was going to do something also. So that's crazy. So should oil be trending down? Absolutely. Now, OZAG. Let's take this one. Let's go to Phil. Was it Tuesday that we did the dividends? When did we do these dividend thingies? No, it was Monday, right? So I need to go to Phil. Need to go to Monday. And now we'll find Verizon, because that was one of them, VZ. There we go. All right, so we were looking at some dividend payers, and ones we talked about were Johnson & Johnson, and then all nice conservative plays. What we do here. So we buy the stock for $119.60, sell the $100 calls. Notice we're selling calls that are $20 below the current price. Very conservative. And so we're selling those for $22. So we're effectively getting paid $122, and the stock's at $119.60. So we're not making any money really selling the stock. But we're getting a $20 free downside protection. That's what we care about. So we're getting our insurance. We're getting free insurance of 20% or 15% or whatever it is. But we're getting like 15% free insurance. And we're getting paid $3 for it, or $2.40 for it. Now, $2.40 is 2%. And you only dividend stocks. The point is, how do I make 5% with low risk? This is how you do it. Now, then we sell the 95 puts. 95 is way down here. We sell the 95 puts for $350. So we promise to buy more JNJ for $95, and we get paid $350 for that. That's another 3%. So now we got our 5%. We net in at $94.10. And we get a 2.7% dividend paid by the company while we wait. And our worst case is that we own 2 times the amount that we start with for $94.55. But if we get call away at $120, we get the 2.7% dividend, and we get a bonus $16. If we get called away at $100, and $16 against 94 is like 20%. So we get a 2.7% dividend and another 20% if all goes well. And the way I worked it out was here, I said it was 7.7% annualized. No, wait. 11.5% in 18 months is 7.7% annual. So whatever, I worked it out to this. Oh, if you don't get all the dividends, that's why, because you're missing a dividend payment. That was Johnson & Johnson. Then we had MMM, was another one we liked. Walmart, Kellogg, Pepsi, and I have the Pepsi charts right, and Verizon. But this is right. Should have been the Verizon chart. I didn't realize I did that. Anyway, so the trick in doing this is you don't buy them all at once. You just start off with one that you want to start with, and you pick one hopefully that's lower in the channel, which Verizon is actually the best one for the channel at the moment. And then on the other ones, you can just sell puts. Just sell the puts. Because frankly, the puts have a nice rate of return. You sell these Walmart $65 puts for $380, right? So here's 65. You sell those for $380. That's 5% right there. You don't have to own the stock. Just sell the puts. So if Walmart comes down, then you'll end up owning it for 65 minus 380. But if Walmart stays up, you just collect your dividend. Now, you do that with Walmart, and then a month later, you do it with another. If they don't come down, I'm saying. If they come down, you can buy them. But if they don't come down, then you do it with Kellogg, then you do it with Pepsi. And after 5 or 6 months, you've got a roll of all these different stocks that you're collecting the dividends on, these short put money on. And at the end of the year, maybe a couple of them you'll end up owning cheaply, and maybe a couple of them you'll end up, most of them will end up expiring out of the money. That's what our long-term portfolio does all the time. That's how a long-term portfolio is built. We start by selling short puts. This is how we initiate most of our positions in the long-term portfolio. We generally try to sell the puts. You see these numbers: 1,600, 7,500, 9,000, 7,005. And somewhere in the 3 to 8,000 range is our sweet spot. That's what we're usually trying to collect here. About 5,000 really is kind of the goal. And if we collect $5,000 for selling puts once a month, what are we going to end up with? We're going to end up with $60,000 a year, and some of those stocks we'll end up owning because they get cheaper. The only reason we would own them is if they get cheaper. Now, out of all these puts we sold them, and by the way, we cashed out, we had much more. We had probably 25 of these things. We cashed out a lot in July, I think it was, when the market we thought was very toppy. So we cut down to ones that we really liked. Now, of the ones we really liked that we wanted to keep, only one is a loser so far. Everyone else is a winner. The loser is SunPower. We just took a big hit. But what did we do? We sold the $13 puts for $3.50. So our net is $9.50. SunPower is at $10. The only loss is on paper, because if we expire at 10, then we actually make money. Anything over $9.50 is a profit for us. It only looks bad right now because the puts have a high price. But as time goes on, time is on our side, and this money will drain out. So we have $10,300 of potential profit here in our portfolio if these things end up expiring worthless. So then once a position goes low enough and we decide to either double down on it or take an assignment or whatever, then we look to see it turn into a position. And if it pays a nice dividend, it turns into a stock position. Or if we like to set up as what we call an artificial buy right, in other words, we don't own the stock. This is a buy right. This is an artificial buy right. The difference is instead of the stock and we sell puts and calls, we pick up a bull call spread. We're still selling calls because we have a bull call spread. So we're selling calls and puts, but what we artificially own is we buy a call instead of buying the stock. And since I'm buying the Apple 85 call for $15 instead of buying Apple for $108, I'm saving $90 worth of buying power for something else. Now, if you're in a retirement account, you're not saving all that money because you sell the put, and the put's going to get margin charged to you. But it doesn't change the premise of this. Is a nice way to make the play. And also, in a retirement account, I'll use this trick much more often, where you sell half as many puts as you do on the longs, because this has no margin. There's no margin to an 85-110 spread. The only margin would be on your $95 puts. But even so, if you look at this play, let's say it's 100. Let's say you have 500 times 100 is 50,000. So let's say you commit 50,000 in margin to this position, right? What's your upside? Well, the net of this trade was 15 minus 8 minus 6 is basically 0. So $0 were spent on this trade. $50,000 in margin in IRA will be put aside. And what's your upside? Your upside is $15,000. No, I'm sorry, $25,000. At 110, at 110, you're going to make $25,000 back. That's a 50% return on your margin in 2 years. So how is that a bad thing? People all the time say, I can't make that trade because I have an IRA. I'm like, what? Like, are you making 50%? Are you making 25% a year in your IRA? That's amazing. So if you're usually making 25% in your IRA, keep doing whatever you're doing. But otherwise, stop worrying about the margin. Just focus on how much the trade's going to make for you. It's not illegal to sell a put in an IRA. They just hit you with a bad margin requirement. So you figure out a strategic way to make the trades. And by the way, another trick though, if you're an IRA, if you're a person who has an IRA account, a trick I use is you put the bull call spread in your IRA, and you sell the puts in a regular account. So that way, in fact, it's even better because Apple goes down, and you lose money on the puts, you lose money in your taxable account. And if Apple goes up, the bulk of your money, this is the 25. Here's $25,000. This $25,000 is made in your IRA. Here, you're only going to make $6,400 in the taxable account. So out of so here you're going to make $25,000 untaxed, and here you're going to make $6,000 taxed. Or basically, you're going to net. You're essentially transferring $19,000 tax-free to your IRA. This is how Mitt Romney has a $300 million IRA doing stuff like this. All right, that's what I'm teaching you to do. I'm teaching you to invest like Mitt Romney. There's all kinds of ways to game the system. All right, so where are we? Let's take a look at the markets. Oh, God, 248 already. So we seem to be hitting a little bit of support here, which is fine. I mean, I hope we have some support. I don't want the markets going to free fall. Natural gas finally hit a top at 280. That's normal. Oil finding a little bit of support at 46.50, which is right where it found support yesterday. But this is a little bit, see how it was very enthusiastic yesterday? It's a little less enthusiastic now, so we'll see what happens. Gasoline, though, that's weird. Although this contract's expiring tomorrow, I wouldn't mess around with it. You want to look at the RB V6, which has probably also got the same profile. V6 is the next contract. And it's much lower, so expectations are gas prices will go quite a bit down over the next month. And if that's true about gas, then why is oil going to stay here? So I still think oil is a good short, but it's just kind of dangerous to play with. Wow, okay. So the NASDAQ, if it doesn't get back over 4,800 soon, that's going to start looking ugly for the NASDAQ. We blew 1240 on the Russell, which is great for the trade that we made because we were shorting at 1250. These guys are obviously down in the dumps. We'll see how the S&P. Well, it's going to be very interesting tomorrow. Everything's looking weak, huh? And the Nikkei still hasn't really fallen. But that's because the dollar is rising. See, it's what I say all the time. Like, you can't short the Nikkei if the dollar is rising because it won't go down like the other guys did. Because the Nikkei wants a strong dollar. The strong dollar pushes these guys lower, but the Nikkei is like, oh, strong dollar, we like that. So that does make it a good short. So I'm sorry there wasn't any good futures plays to make today, but we were already in crashing mode, so there wasn't anything fun to do. I certainly don't want to play for a bounce. I think we need a good, healthy correction. We do. And we haven't had it. The Fed doesn't let us have it. And meanwhile, Yellen is doing her thing on Friday. So you can't even, this thing could flip immediately. It could go either way so fast your head will spin. So I advise not playing the futures today, tomorrow, or Friday. I really would stay away from any kind of futures play because things can get really nuts. And then after that, we'll have more information. Hopefully we'll be able to make a better trade. All right, so like I said, I'm going to update the portfolios this week. Some of the new trades aren't in it, but let's take a quick look and see how we're doing. So long-term portfolio, 100, crazy. This is a very conservative portfolio. It's insane that it's up 116%. It really is. And even more insane, though, is that the short-term portfolio, which is where we hedge the long-term portfolio. So the short-term portfolio, we only start with $100,000. It's 1/5 the size of the LTP. And it's used primarily to hedge the LTP. But insanely, this thing is now almost $500,000. This is almost as much as what the long-term portfolio was. What's the actual number? 462. Yeah, it's almost $500,000. And look at that, 468. More than all of this money is in cash. So we have more cash than our positions are worth at the moment. That's how cash we are. We are 100+% cash. So am I bullish? No, I'm not bullish. I don't want to miss a rally, so we still have long-term portfolio positions, and the same goes here. This is the options opportunity portfolio. We're at 85%, and that's the guys that dropped a percent while we were talking. We have a mix. We have a lot of hedges. We have a lot. If it weren't for the hedges, this thing would be up 100-something%. But we are hedged because we are extremely concerned there will be a disaster. And then last of all is the butterfly portfolio, which 177. Oh, 193. Oh, no, that's wrong. It says 193 probably because of some incorrect numbers in here, I think. Yeah, you see how these Microsofts are zeroed out? They're August, so I haven't cleaned this up yet. This is wrong, because they can't both be zero. Anyway, so the butterfly portfolio is also doing very, very well. Also, ridiculous amount of cash. 260 out of 293 is cash. But you don't need to be fully cash, and even the margin. I mean, it's 260. What's that number? Oh, 293. So it's almost 300. I mean, 293 out of 293, which would have 600,000 in buying power. We're using $94,000 in margin. So we're using like one fifth, not even about margin. And we're making, let's see, 3 years, we're making 50-60% a year. You don't have to go crazy to make money, but you have to be patient, okay? Because we build these positions over time, and we go in very methodically and very carefully and very conservatively, and we hedge. And the real reason these things are successful is because we do it year after year, month after month. We make sure we're always getting paid. That's what being the house is all about. Here we say, be the house, not the gambler. We're the casino owners. We establish a position where other people will pay us to bet on which way things are going. We don't really care which way the market goes. We just want other people to bet on our positions. And we'll take their bets and we'll take their money. Because we know that over time, as long as we get our fundamentals right, which is important though, I mean, you need to pick a stock and know and understand the value. So once we get our fundamentals right though, we'll be in a range where we're going to make most of the time we'll get our money. Just like a casino. Casinos don't always win. The casino doesn't shut down when they lose on roulette. Of course, somebody's going to hit a number, and sometimes somebody will hit 2 numbers and get really lucky and whatever. And somebody will walk out of there with a big pile of chips. That's the casino's money. They know that. You can't win every time. You just have to win enough of the time where these statistics go in your favor, and over time, your money pile grows and grows and grows, and these little hits don't matter. And that's the way we invest. It's a great system, but it takes time and patience to set it up. And we don't chase things. We don't jump into things. And there are certain times, like unfortunately, basically this whole summer, that we're pretty much sitting on the sidelines because there's just not enough good bargains to buy. Although I just showed you 7 in those dividend stocks. But even there, like I said, they're not all cheap. They're of the dividend stocks I was looking at, which I probably looked at like 100 of them. Those were the 6 or 7 that I said, okay, these guys I would still put money into. There aren't many. Oh, an FTR. We're on the identified FTR today. There aren't that many stocks I would really willingly put money into. But I found a few, and we have tons of money. So we put a little bit of money to work in our long-term portfolio in the last couple of days. I sent out like 3 different top trade alerts this week, which is very rare to send out 3 in a week. Why? Because maybe we're too bearish. Maybe. And if we're not, the stocks that I sent out the notes on, they're all stocks I don't mind buying more of if the market tanks. But the key is to have that money on the sidelines and to be patient enough to know what to do with it. Warren Buffett, 2nd richest man in the world, 3rd richest man in the world, whatever the hell he is, same philosophy. He goes years without making a play. Years. Yet somehow, after 50 years, he makes an average of $1 billion a year. Personally. For his company, well, I mean, technically his company's worth $300 billion, and it used to be worth 0. So he made, in 50 years, he made $6 billion a year on the average for his company, and he took about 20% of that money for himself. Perfectly reasonable. In fact, that's basically what a hedge fund guy does, right? So he acts as a hedge fund for his investors. If you have the patience and you have the long-term view and you manage your cash, you can make money like that. But it doesn't, it doesn't work if you jump on things or you chase stuff. And like Exxon, for example, John, I understand it's annoying to see it go down to 269 in a day, And honestly, I didn't even think we had the position anymore, but let me see. But until I find out why it went down and what's going on and I read about it, I wouldn't react to it. Because I'm a fundamental investor. I want to learn about the company. And sometimes waiting is good, sometimes waiting is bad. But on the whole, I'd rather wait because then I know what I should be doing. All right, so that's it for today. That's my lecture on patience. And that's not like, certainly next week we'll try again with the futures trading. I haven't had a good opportunity to do the futures, unfortunately, because it just hasn't been a good position. And again, actually, the number one lesson in the futures is if you don't see a setup you like, don't trade. Didn't see a setup I like. We started this, where were we, at 1 o'clock? Ew, I don't like the scale on this. So we started the webinar at 1 o'clock. And I thought, I didn't see where I wasn't going to invest up, and I wasn't sure what was going on in the market, so I didn't say anything. And now we've been trending down. Now we'll trend back up, and we'll end up right about here at 18.5 again. But it's a drippy, trendless market that you can't really. It's tough to play. So I wish it was easier. I made a call this morning. This morning was easy. This morning I said short because we were way up here. That was an easy call. Now we're down and obviously hitting some, look, see this S2 support down here, this double green line? Of course that's going to be bouncy. You hardly ever break below that line. You're almost never going to break the second trend line. Very rare. But here you go. Here's gold breaking that second trend line. So gold's having a rough day, but then gold is one where you got to look at it and say, is there any good reason? Is there a reason it might turn around here? Now, no particular reason at this exact price, but I mean, frankly, gold, it's something you might want to look at and say it should at least bounce. You should at least get back to 1330. And if you want to make a little bit of money from 1327 to 1330, then go ahead. And the same thing goes for the NASDAQ here. The NASDAQ's going to bounce. As long as it holds this 1490 line, then probably it'll test 4800 again. And that's a $200 move in the NASDAQ. You can play things like that if you want to. But, like I said, it's nothing worth like getting heavily into. All right, but I think the main lesson today, though, is let's look at these retirement accounts, look at this system to play. and the point I made about the retirements was, look, if you can consistently make 15%, in fact, compound interest, right? Compound interest. It's good because I can actually show you. I talk about it a lot, but here you go. Okay, so let's say we start with $100,000, and every year we're going to put in another $5,000. Okay, so I'm making $100,000. I've got $100,000 saved up. I make $100,000 a year. I'm going to put 5% of my money into my account every year, no matter what. I'm going to do that for 20 years. Okay? So if you do it in the bank and you get 1.5%, you're going to have $252,000. It's not terrible, but not great. If you do it with dividend stocks that pay you an average of 3%. Now remember, 252, 318, 3%. But if you can get 10%, $1 million. So getting 10% gives you 4 times the rate of return you would get from a safe investment. 4 times. Now at 20%, gotta calculate. $5 million. Not even, off the charts more money. I guess that's 4 and then 20, like 20 something times more money. You can make 10 to 20%. $1 million to $5 million out of $100,000 in 20 years. You can. But to do that, you shouldn't be trying to make 50%. Okay? That was the point of those retirement plays that we were talking about, those portfolio, those dividend plays. You can easily set up a very conservative portfolio that's going to give you 10% returns, 15% returns every single year. And it'll compound and it'll grow over time. And by the way, that's not included here. You could reinvest the dividends and add to this substantially, because reinvesting the dividends would be as much as another 5. So if you reinvest the dividend, watch what happens here. If you up that to $10,000, let's say you're putting in your 5 and you're reinvesting your dividends, right? $5 million becomes $6 million. So just reinvesting your dividends, along with the money you're putting into the $100,000, you added $1 million to your portfolio. And that's reinvesting $5,000 worth of dividends 20 times. So, you know, when Ben Franklin says a penny saved is a penny earned, he was understating it by quite a bit, right? You know, eventually, look, rates will normalize, you'll get better money for bonds, so on and so forth. But for now, these blue chip dividend stocks are, you know, setting them up with conservative options plays. And you can be more conservative. You can drop it. Like we're going for 15%-ish, you know, in our trades. You can drop it down to go for 10% and be more conservative, and you can withstand like a 30% market correction. And again, and I'm not saying do this with everything, because think about it. If you can do this with $100,000, right, you could take half the money, $50,000, and invest it safely and get your normal return on the $50,000, which would be $125,000. You'll get your normal $125,000 safely. But then the other half of your retirement money, you would put into a more aggressive portfolio that can turn into $3 million. It won't be $6 million, it'll be $3 million. But you know what? If you don't do that, you'll guarantee that you'll have $250,000 when you retire. Remember, in the safe in the bank. So you have $250,000 in the bank or in T-bills in 20 years, or you'll have a guaranteed $125,000, which is really no more money than you have now, and up to $3 million if your risky part does well. So it really doesn't make sense not to take the risk with some part of your money, just to be a little more aggressive and do it. But again, it also doesn't make sense to take all of your money because you don't need it. Honestly, if $100,000 means a lot of money to you and you can get $3 million in 20 years, don't tell me you need more. You don't. Because that $3 million at 1% is going to return you $30,000 a year. Just 1%. If you get 1% then, you're going to get $30,000 a year to live on, in addition to whatever else you have for retirement. So it's not a problem. So I can't emphasize that enough. I mean, that's the whole. We have an article called "Get Rich Slowly." I'm pretty sure if you just type "Get Rich Slowly," it'll, you know. Oh, look, even Google's. How nice. Get Rich Slowly. No, that's me. This one on Huffington Post. I can't believe the Phil Stockwell version doesn't come up. That's annoying. I hate Google. Really? Unbelievable. So anyway, so I wrote this. But here, you know, this is the stuff I'm talking about right now. How to get rich slowly. We even have a little video, how to get rich slowly. All right, so there's that, and then this probably has some links to some other videos, hopefully. Yes, you be the house, not the gambler, buying the stock for a discount, the secret to consistent 20 to 40% returns. You know, if this is new to you, and even if it's not new to you, if you're not following this kind of philosophy, really you've got to consider it. Because this is how you build wealth. It's always fun to play the market and get this and that hot stock and whatever, but if you want to be serious about investing, if you want to retire in comfort, You have to work at it, and this is how you start and work at it. All right, so end of that commercial. Everybody think about it, and we'll talk about it some more next week. ADX down 9.5%. Cannot wait to buy more. All right, have a good day, everybody. Take care.